And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for another special live stream with our good friend, Andy Schectman. His firm, Miles Franklin, is the officially endorsed precious metals solutions provider by Thoughtful Money. Andy's been joining us a lot recently. I had told him I was hoping to give him a bit of a break, but the action just hasn't let up in the silver market. So anyways, first, Andy, thanks so much for joining us.
Always a pleasure, Adam. Glad to be here.
Folks, it is an incredible busy time for Andy. So the fact that he's willing to drop everything when I ask him to and come on here is a real privilege for us. All right, Andy. Well, look, every time we talk about the potential for the precious metals going higher, despite how far and how fast they've moved. And the last time I talked to you, I asked you, is it time to sell, especially silver? And your answer was no. And that has proven so far, at least, to be a prescient answer because the precious metals continue going higher. The day we're talking right now, silver is at $93 an ounce. And Andy, I remember when silver was in the high 60s or low 70s, I said, you know what, $70, 60-something dollar silver makes Wall Street start to think about $75 an ounce silver. And then $75 an ounce silver starts to make Wall Street think about $100 an ounce silver. And that's the way it's been playing out. It seems like that magnetic tractor beam of the big round number is starting to really pull hard on silver. Same thing's going on with gold. Gold's had actually a really nice run since we've talked. The day we're talking here, it's somewhere over $4,800 an ounce. That theoretical $5,000 an ounce target does not seem so theoretical anymore. Again, another really big round number with the tractor beam pulling the price and people's psychology. So, Andy, I had to title this live stream before, obviously, we shot it. And the question I put in the title was, okay, let's say we hit those big round numbers, $100 an ounce silver, $5,000 an ounce gold. In your mind, what should folks think about doing at those milestones? Is that, my God, we got here so much faster than we thought, sell, consider yourself lucky? Or are you seeing such momentum still in the system? You think this whole rising tide is going to continue going higher from here?
I think the first thing you have to understand, Adam, is that gold and silver really forever have not been allowed to reach real price discovery.
True price discovery.
Yeah, and where is it really? I think if you want to know the real story, watch the delivery behavior. And, a standard Comex contract is 5,000 ounces, right? And what we saw in December was the largest delivery in the history of the Comex market for the month of December, 68 million ounces. Now, a mint box of Silver Eagles weighs 500 pounds, or 500 ounces weigh 42 pounds. Who just bought? Actually, it was 64,730,000 ounces were delivered in December, the largest ever in the history of the Comex. And January, which is not a scheduled delivery month, we've already seen close to 40 million ounces of silver delivered, maybe more. Last I checked, 110 million ounces in the last 40 days. And there's not a word about it, or 5 or 6 million ounces of gold along the way with that. Not a word about it. And that's what we have been seeing for the last 15 months, every single month. Not a word about it. I scream about it. The mainstream media, these jokers who actually think that they are doing right by the public, don't speak about the fact that gold and silver have eviscerated the S&P in the midst of the greatest tech boom in history, and even more relevant than the performance, which has been amazing, is the deliveries. Now, the deliveries to me say everything. The deliveries are being done by the most well-informed and well-funded traders on the planet, period. Now, I've been for 5 years saying it's been the central banks, and they started the ball rolling. That was crazy enough, and it occupied a part of every one of the 6,000 podcasts I did since 2019. But what you see right now is the most well-informed traders here in the United States. And that's a whole different thing. And delivery at that level should not be ignored. In fact, to me, it's all you need to see. Now, in a market like we see right now, I promised you, and I've said it before, I said it last time we were together, I will tell you when I think it's time to bail.
Right.
But this is not even close to it. The dips that we see right now, in my mind, are a gift because they are driven by positioning and leverage, and not by a sudden surplus of metal, period. And I think that the risk is waking up, not that not that silver goes down from 95 to 85, or the gold goes from 4,800 to 4,500 in this big correction. I expect it. I expect a correction, and one is corrections are normal, but the risk to me is not being able to get what you want at any reasonable premium, period. So yes, short-term caution is appropriate. Long-term conviction is also massively appropriate, in my opinion. They should both be able to live together. And look, when you see the Shanghai market in silver pricing above $8, $9, $10 above Western spot and futures, it's basically the market screaming that the metal is worth far more than where it's being financially priced. And when you see the lease rates going way up, the widening spread is a signal of tightness in the market. And it's not a rounding error that we continue to see. The raising of margins. That's what in 2011, they jacked the margin rates up so high, it flushed everyone out. This time, they raised margin by 30% the day after Christmas, from 21,000 to 27,000 in your margin account to control one 5,000-ounce silver contract. Shook all the people out that were using margin and needed to sell to cover these margin requests or demands. And if you didn't pay it up by the end of the day, then you get a margin call. Well, what happened? Normally in 2011, and normally that kneecaps the market. These people that are standing for delivery for 100 million ounces in 40 days, do you think they're using margin? No, they're not. This is the highest level of high. These are central banks, commercial banks, Tesla, Samsung, you name it. Tesla and Samsung would be poor compared to the people that are standing for delivery at this level. These are sovereign nations. This is the US government. This is repricing in an asset that has never been allowed to find real price discovery. And I do believe that. And I think when you use technical analysis in a rigged market, it's invalid.
Mm-hmm.
And I think what you see here is a microcosm of what I expect to see. Part of the way that these banks have been able to save themselves is through rhetoric. You never see the media talking about it, right? Never. And that's always bothered me, but it is what it is. But the rhetoric is, very important. So TD Bank, right? There's this rumor that Tom Luongo has that, and I think he's someone worth interviewing. He's a very smart man, and his theory is that Trump said it today in Davos. He said, the election in 2020 was rigged and people are going to get prosecuted. He said, I probably shouldn't have said that. That's breaking news, but it's coming out.
Yeah, I heard that.
And so Luongo's theory is that he believes it was the European aristocrats, and the way you get them is to blow up the positions on the LBMA. In essence, that's part of what he thinks, because the Economic Times says the 5 U.S. banks that were short have flip-flopped and gone long. No, that's what the Economic Times says. JP Morgan covered a 200 million ounce short position, they say, and have been buying millions and millions of ounces of physical. And that the 5 banks of the 8 Western banks that were short all of these years collusively going back and forth to hold the price of gold and silver down, the U.S. banks are now long, exposing the short banks. So TD Bank, I'm going to read to you what TD Bank did in Canada. They came out 2 weeks ago and said, we enter short spot silver anticipating a dramatic reversal in prices as silver's devilish blow off top comes to completion. TD Securities entered a short position in silver futures in early January 2026, betting the price would fall towards $40 an ounce. They placed a stop loss around $92 an ounce to limit losses as the price went the other way. And guess what? They just got stopped out on Friday. They're $92 an ounce. They were hoping that they could engineer this, and it's not working anymore. And I think you see a repricing of gold and silver that has even yet to even begin to find equilibrium with where it should be. So yeah, I'm not a perma bull, but I do believe that this is just beginning. I do believe that.
Okay, so many questions that came out of that. Let me bang through a couple things. First off, you talked about the premium on the Shanghai exchange, somewhere around $10 an ounce. Can you explain to folks exactly like why the imbalance there? How come there's not an arbitrage that closes that?
That's what they're trying. They keep keeping it there to arbitrage it instead of closing it. In other words, the traders who have the ability to buy paper in the West and deliver physical in China are doing so. You trade it, you give them a million ounces, you just made 8, 10, 12 million dollars. Give them 20 million ounces, you made what? A lot. You make $200 million, easy peasy.
Let me make sure I understand then. You buy paper contracts in the West, you stand for delivery, you get your silver at whatever the current spot price is in the West, let's say $93. You then take that physical and you sell it to a Chinese buyer in China for $10 more?
Yes. I mean, what people don't realize is that there is a Comex contract that delivers in Hong Kong. And it's into a Comex facility. So you can deliver Comex contracts, what's called exchange for physical, where you actually deliver the physical in Hong Kong. It's then picked up by a truck and driven to the Shanghai Metals Exchange.
Wow, so you don't even have shipping costs from the West over there. You just pick it up in Hong Kong.
Yes, or sometimes they have to ship it there. But the bottom line is that there is a Comex contract that does deliver in Hong Kong, part of the Comex ecosystem. Would have been probably a Brinks facility. I'm not sure which one it is, but yes, and that's exactly how they do it. So they buy the paper in the West and deliver it in China. And so you end up exchanging for physical, making a huge arbitrage. But and they keep doing it to do that sucking sound you hear in the distance. That's them trying to entice. Yeah, keep giving it to us, please. We'll take it. We'll take it. We'll take it. That's what they're doing because they're using this huge trade imbalance that we've given them, the surplus of dollars, to buy up things like silver. So you keep that price higher and you entice those traders who can do it to deliver the metal there. That's exactly what they're doing.
Okay. So let me ask you this. So you said we're seeing record delivery globally. You think it's sovereign players that are hoovering this up. You just explained how China wants to get its hands on every bit of ounce it can because it can make an immediate 10% per ounce pop on it. At current rates, at current flows, current monthly volumes of silver kind of being taken out of the exchanges. Do we have kind of a projected timeline of like, wow, if this keeps continuing, will it drain the LBMA? Will it eventually drain the Comex?
Well, yeah, I mean, listen to what David Jensen says. He's the expert on the LBMA. He will tell you that there's 700 or 800 million ounces of silver in the LBMA, of which the majority belongs to the ETFs like SLV, storage programs like Bullion Vault that store it there. That's not for sale.
Right.
He will tell you they say there's a 140 million ounce float, which he disputes and says, I don't know if that's really free float. Difference between a float and a free float. The float meaning, or the free float meaning the bars standing behind the contract. So he will tell you there's 2 billion ounces of paper contracts outstanding against a 140 million ounce float. Now, what could possibly go wrong? And that's why they went to T plus 8 weeks for most of last year. What do you mean? It's a T plus 1 day settlement. Well, we don't have enough in the way of manpower and trucks, the Bank of England says. So you have to wait 8 weeks to get your bars. Really? That sounds to me like you got caught with your hands in the cookie jar.
Yeah.
And that's exactly what is happening. Now, the part that I think most analysts have a hard time dealing with is the fact that we live in a world of instant gratification here in the United States. And, look at how fast things have moved in terms of, is it a new world? I was talking about this and to someone else. My wife was next to me the other day. She said, but it's different now. The world is different. No, it's not. Richard Russell used to tell me, who was one of the greatest human beings I've ever known in my life, that if you made 7% per year, you will go down in the investing Hall of Fame. But that changed with Apple and Nvidia and Bitcoin and this instant gratification of, 5-fold increase in profit is something that is not sustainable in normal markets. And so I think that people have a hard time understanding that Well, why don't they just buy everything up? Because they would cut off their nose to spite their face and blow up the exchanges and everyone would figure out what they're doing. But if they cut you with a piece of paper over and over and over and over and over and over again, a little cut, little bit, little bit, little bit, little bit, little bit, and now someone, thank God, has woken up in the West, here in the United States. Thank God someone got to this administration and said, we are being paper cut to death. If we do not do this and start becoming massive importers of this stuff, and we'll call it tariffs, it's not tariffs, it's reshoring. If we call it tariffs, they'll believe it, because these banks were all collusive together, the Western banks. Mm-hmm. What, in essence, Luongo is saying is that Trump flipped the script. He's very angry and believes it was the people, the Russian, the European elite, the aristocrats, the old money that was behind all this, that did everything they did to keep him out of office. So we'll flip-flop. There's this massive short position that you guys have, you 5 Western U.S. banks. We're going to say it's tariffs. Don't worry, it's only one way. Well, the bars will come back, just we need to cover. No, we need to reshore. And now we go long. And what happens when there is a failure to deliver? And I've told this story over and over and over again about Bear Stearns and Bart Chilton and his interview on Chris Marcus's podcast and on Andrew Maguire's podcast, where he admits that Bear Stearns largely went bankrupt because silver went to $21. They had the largest short position. And what happened after that with JP Morgan. And the head of the CTFC admits this on these podcasts. No one talks about those things that are mainstream analysts. They just think we're crazy for saying things like this, yet they keep happening. And I keep getting proven right. And I'm not saying I'm a soothsayer or anything. Maybe I'm just stupid enough to say these things in public. And when I'm wrong, I admit it. Or if I say something incorrectly, I admit it to you, to your fellowship and publicly, by email and out here. Yeah, I make mistakes, but I believe what I say, and I say it with respect, right? I think that this administration is making good for the errors of previous administrations by reshoring critical commodities that the rest of the world has figured out long before us and are using the ability to stand for delivery against us because nobody ever did. These countries that had started the ball rolling were never coordinated, motivated, sophisticated, or wealthy enough to stand for delivery. They had no desire to do so, but now they are. And it is the Achilles heel to the entire system. And when Bix Weir used to say that, I'm like, well, how can that be the Achilles heel? It's just the silver market. I don't get it. Think about it. If a bank like Bear Stearns went bankrupt, and if it weren't for JP Morgan taking it over, according to Bart Chilton, the head of the CFTC, well, what if it happens on the other side? What if Bear Stearns has a failure to deliver? And all of the things that Bear Stearns is involved in, equities, Forex, interest rates, you name it, boom, 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 everyone yanks their money out and the contagion blows the whole thing up. Now, could that happen? Yeah, absolutely it can. And to think it can't is stupid. And to play this game of it always being about normalcy bias is, I think, a very big mistake. So yes, this is something that could get really crazy. And I don't even think we've begun to see it because they've never let it get to real price discovery, whether it be the West wanting to hold down silver due to the military industrial complex's need for cheap silver to make weapons to rule the world, or Gibson's paradox, which is the inverse relationship between real interest rates and gold. The West, who ruled the world financially, didn't want gold to go higher when they embarked upon a zero interest rate policy because they offshored all their manufacturing. We got to make people still feel wealthy. How do we do that? Suppress interest rates. Okay, now everyone's wealthy. Their 401k went way up. Their house is an ATM machine because they can refinance it, pay less than they did before, take out money, take a trip to Hawaii, buy four Wave Runners and a new car, and still pay less than they did last year. That's what zero interest rate suppression did. You had to kill the canary in the mine shaft, which was gold. This is what's happening now, largely to the economy, where an economy has been distorted with asset prices that are way out of whack based upon years of suppressed interest rates. What happens if rates rise? This is why they can't let rates rise. And so this is all part and parcel to why the rest of the world does not trust the West anymore, because of what we have done largely militarily, weaponizing the treasury, suppressing interest rates and creating distortions in asset prices. All of these things you could say is a major departure from the moral high ground that we stood upon after World War II. The world now gets it. And they're getting it through standing for delivery. Thank God someone in this country got to this administration and said, we need to do the same thing. Because I will tell you, all you need to know about anything is look at the deliveries every month. The people doing this are the most well-informed people in the world. And whoever it is, and the fact that there's no communication by the mainstream, are standing for hundreds of billions of dollars with the gold and silver, billions every month, and no one says a word. That's all you need to know as to where the trajectory.
Yeah.
That's Michael Oliver. That's momentum. Where's the momentum? Right there. Look at the biggest money in the world doing it right here in our backyard. It'd be nice if the media told us about it.
So another Michael Every, for many, many years was kind of warning the world about a return geopolitically to mercantilism versus globalism. And Michael was a student of history and says, look, mercantilism's kind of been the rule of the game, and this era of globalization that our generation grew up in, he said that's the historical aberrant period, and it's not. He was saying a decade ago it's not going to last, and we're going to go back to mercantilism. I think we're now seeing that in real time here now, and shorthand for understanding mercantilism is just nations become very focused on, hey, me first, rather than holding hands with everybody in kumbaya, and we're going to build this wonderful future where everybody gets along. It's more kind of Game of Thrones, right?
As it should be in this country. I mean, we should take care of our own. You need to bring back manufacturing. You need to have secure borders. You need to do these things. And God bless President Trump for doing it, because the nobility in what I believe he is doing is lost on almost everybody. They don't get it. I see it because I dig into this stuff every single day. He's trying to bring back manufacturing, and if we don't, our kids and our grandchildren are dead. We're broke. Ray Dalio says 60% of the country has a literacy rate under the 6th grade. We're uneducated, we're broke, we're insolvent, we don't make anything. And here comes AI just in time. So all I'm saying is that we have to do this. And if you play it out and see with the Genius Act, with pegging gold to the back end of the bond market, all of this stuff speaks to a devalued dollar, relinquishing the reserve status, the global reserve status, taking care of us, bringing back manufacturing. It all speaks to that. And I could not agree more with what you just said. In fact, I've never heard it said that way. And I'm going to borrow it, and because I think it's genius. Steal
it away. And really, it's all attributable to Michael and others. I'm just the medium repeating it. But so I want to connect that, because it's not just America, right? It's the world. It's now returned to a mercantilist era. A lot of countries like China never actually left the mercantilist world. They were happy to take advantage of us while we were being overly liberal, overly generous. And so I think we've got two things going on here now, right? Where we've got all the countries that are saying, okay, look, I'm not about necessarily playing ball as a global team anymore. They got to take care of my team or my folks. So these are essential minerals, essential metals. I want to do whatever I can to lock up, my access to it, right? So we've kind of got this global scramble for that. At the same time, you said sort of through this process, it's willingly or not, they're moving to an era of price suppression to true price discovery, right? So we've got true price discovery, raising these metals, right? Because you believe they've been suppressed for so long. But at least, I don't know so much about gold, you can comment on this, but certainly for silver, the scramble seems to suggest that scarcity will be an increasing factor going forward, scarcity of supply. One, because countries are now competing for it much more aggressively, but two, as we've talked a little bit about in the past, silver gets harder and harder to find. Right? The pure silver veins have largely all been discovered. It's a byproduct of other types of mining. It's not easy to just flip a switch and get a lot more silver output. So we've got sort of two big trends going on. We've got the price discovery and we've got the scarcity. Am I summarizing similarly kind of the major macro trends that you see here?
Yeah, I mean, look, I think people will start looking for real money again. People will start looking for real money again, and that's a repricing. And I say that like this. I go back to Richard Russell. Money used to be slow, right? You earned it, you saved it, you invested. That's Austrian economics, where you save, you invest, you reinvest. And you did it into things that actually produced value, factories, businesses, etc. But today it seems that money isn't slow anymore. It's fast. It's created instantly. It's pushed into speculation instead of production. All the money that was created after the 2008 financial crash, well, we didn't see inflation because it went into financial assets.
Yeah, we saw financial asset price inflation. Yeah.
Right. And so most of that wealth that people see today didn't come from real growth. It came from financial bubbles and speculation. And that only works as long as trust holds. And I think for a long time, the US or the world absorbed our inflation by holding dollars as reserves. But once the dollar was weaponized against Russia, really, that trust began to break. And then when confidence fades, this privilege that we've had turns into a liability. It's funny because VanEck, which is the mutual fund company, they just came out and they said if the dollar loses reserve status, could gold surpass 39,000? This is by VanEck. I'm just going to read one thing. It says, what if gold replaced the US dollar? Now, I would say, what if gold replaced the US Treasury, which I believe it is, as the reserve standard? And here they put the reserve. So the dollar, you know, you go back to mercantilism, all these countries are using their own currencies, trading over networks that are not compatible with the SWIFT. We're seeing that all throughout the BRICS, right? It's already happening with the SIPs, the cross interbank payment system, and Enbridge, both operational now, trading local currencies and using gold instead of treasuries. But it says, what if gold replaced as a reserve standard? In this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to $184,000 per ounce price. If using M0 money, which is the foundation of money, it's just the money that's immediately available in currency, for the entire monetary system globally, every dollar of credit, debt, and leverage is ultimately built on top of this, blah, blah, blah. We see gold at $39,000. If we use M2 liabilities divided by gold reserves, $184,000. That's VanEck. That's not James Rickards or me or Mike Maloney. Right? That's VanEck.
How much was the M2 based one?
$184,000.
Oh my God.
M2 liabilities divided by gold reserves is $184,000 per ounce, weighted by daily FX turnover. Using global M2, where we have global series, unlike for M0, we calculate the global price of gold that equalizes M2 is around $100,000 per ounce, weighted by daily FX turnover. The gold price that equalizes M2 is $184,211. That's from VanEck. So I'm just simply saying that these things have never found their price discovery in a world where it was all based on trust. The trust is gone. Our fiscal responsibility is thrown to the wind. And the world is looking for alternatives to a system that had been weaponized against other countries and wonder, is it us next? And it would be very wise to not be reliant upon just that one entity that can make and break you based upon the way that they look at you. And so I don't know. Yeah, I think you're going to see this accelerate in gold as well. Silver is where the real horsepower is. But let's just be honest. I don't really have anything that will illustrate its size, but a D battery that you could hold in the palm of your hands is a tube of gold eagles. It's $100,000 now, basically. When I started, even as recently as when I started doing shows with you, $100,000 in gold would have been closer to 50 ounces, maybe 45 ounces. Now it's closer to 20 ounces. It's accelerating quietly. And that's the thing is that, people.
That's a good way to say it, though, it's a little big, but I could basically conceal $100,000 in my hand with gold.
And that with silver, it used, when I started doing these with you, would have been probably about 1,500 ounces minimum, maybe even closer to 2,000 in silver. Now it's 1,000 ounces is $100,000. And so it's accelerating, and you don't get any media coverage of this. The public is being left out by design. They don't want to be crowded out of their trade, and when there's a fine line between conspiracy and reality. I talk about the Bart Chilton. Here's another one people should watch, and that is Bick Sweer. His YouTube channel is Road to Root, a wonderful, wonderful man. Love the guy. And he did a 3-part series 2 years ago with a man named Jack Sermon. Jack Sermon is and has been since the beginning of the mint the guy that runs the Silver Eagle program. He said 2 years ago that his superiors came to him, which would have been Janet Yellen, and said, make the smallest number of eagles you can make without creating a global backlash. Why do you think Silver Eagle premiums during the pandemic were up to $16 everywhere around the world? Why? I would have paid you 11, 12, 13 over spot for as many as you would sell me. Why? He says that the primary distributors came to him and said, we'll take 36,000, we only gave him 12, or 36 million, we only gave him 12 million. What he is basically saying is that he was told to limit production and distribution of Silver Eagles, yet the law that is in place since the day the mint was developed in 1986 says that they are by law required to produce as many Silver Eagles as are demanded. And he comes on his show, Jack Sermon, the guy that runs the Eagle program, 3-part interview with Bix. Yeah, I was told not to do that. I almost fell off my chair. So when you talk about conspiracy, reality, where this is going, where the people in power have an idea where this is going, a lot higher than I think the mainstream or your financial advisor will tell you. And it's about time Wall Street and the financial advisors admit they were just flat out wrong. They've been wrong, and yet they still can't do it. It's the devilish blow off top. They ignore fundamentals, they ignore reality, they ignore lease rates, they ignore backwardation, they ignore arbitrage, they ignore all of this stuff. And anybody stupid enough to short a market in backwardation gets what they deserve, like TD Bank. And that's where we're at right now. I think it's in the midst of repricing globally.
Can you just real quick, since you used the word, define backwardation for folks?
Sure. So a normal market works in what's called contango, where the current price that you buy right now today, call it spot, is less than the futures price. Why? The futures price would imply interest and storage and the cost of money, right? So if you're going to buy it out,
risk,
yes,
right? You might not deliver it to me in a month. Yeah,
right. It's risk, it's interest, it's storage, cost of money. Backwardation says, because of what you just said, I think the risk of you not giving it to me is greater than, I'll pay more for it right now, thanks.
Right.
And so if you're going to pay more for it right now than you will out into the future, anyone who's stupid enough to short it right now gets what they deserve. And that's what you saw with TD Bank. And see, this is a thing, is that in the West, we have a very hard time believing that this could actually happen, that we've actually been beaten at our own game of metal suppression by these countries that were third world most of our lives, that are now sophisticated and say, you want to play a game where you suppress the world's commodities that we're the ones that produce more than you and use more than you and appreciate and have a history of it more than you. Great. We have more money than you ever thought we had, thanks to the trade imbalances you've given us. We're going to stand for delivery. And when that happens, the paper game breaks. It's Bernie Madoff. Everyone was thrilled making their monthly checks, right? Until someone said, I need my money back, though. The principal, okay, I need it too. I need it too. I need it too. And then Houston, we got a problem.
All right. Yeah, while you were talking there, I just put up this cartoon that Axel Merck had created, 12 years ago, 13 years ago.
Yes.
Very prescient. But yeah, to your point, we got more money, and a lot of it's, we got your dollars over here, so we're just going to send them back to you for the metals. And
that's right.
The metals start piling up in our country, and the dollars start piling back up in your country. Who's really winning?
Yeah, that should have been titled foreshadowing, and it should have been, and no one would have believed it. It was just a cute thing then, but now it's reality. That's the arbitrage. That is them saying, sure, yeah, we'll give you lots of money. Go ahead and send it over here. We'll even pay you a whole lot more than you can get it for in the West. Thank you. That's exactly what that arbitrage is right there.
Okay. So let me ask you this. So if the world is developing a newfound appreciation for the value of these metals, this might be asking you to speculate a bit, but do you see an element in what the U.S. has done recently with Venezuela and now with Greenland? There are lots of reasons for why it did what it did, many of which probably you and I will never be party to, Andy. But do you think access to more precious metal supply is a part of either or both stories?
Well, I don't know if it's precious metals or just strategic metals, and even Trump talked about it today. He said it's a giant piece of ice. It's not about the rare earths. He even said that, but it is. It is, and yes, of course, this is about national security. You know, there's
Right.
that.
But,
There are
but
those.
Venezuela has one of the largest gold reserves around, I think. I don't know what the deal is with Greenland, but I got to think large landmass, totally untapped. There's probably some precious metals in there
Of
somewhere.
course, it is. It's precious metals. It's rare earths, of
It's a
course.
bunch of other stuff too. Yeah.
Yes, it is, and I think there is a new realization that these things are critical. We lived in a world where paper and debt from bonds and stocks were all that you needed. But if you ever there's that game that you can play on your phone that's been around forever. It's like I don't know what it's called. You build a world and you start with sticks and stones, and by the end of it you're flying in spaceships. But in every respect, it's about accumulating things that you need to build an advanced civilization. And that's where the West has ruled the roost for so long, they never had to compete with the rest of the world. And when you and I were kids, China and India, these were third world countries.
Yeah, they were largely backwaters. Yeah.
Now they're not. And now they're very sophisticated and very wealthy. And they say, ha, it's not about the paper. It's about the real things. And they're doing it. And that's the realization that is happening. And you look at 1980, two brothers trying to corner the silver market. You look at 2011, leverage and speculation. Those are easily defeated by raising margins or changing the rules on the Comex. When it is sovereign nations saying, let's go, giddy up, go get it, buy it everywhere you can or else. Well, you can't say that out loud because the world is globalized and connected so much with communication that bang, 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 you get traded out of you get stopped out because everyone goes to get it. But if you quietly say, if we don't do this, our future generations are in big trouble. You have nations now fighting for a limited supply of critical assets that are needed to build a advanced civilization, period. And it should have been realized a long time ago. But that's where we're at. And I think that's the difference between previous cycles. And the West controlled the price forever.
Right. And that's why you don't think, even though it looks similar to the price blow-offs we saw in 2011 and 1980, that's why you think it's different this time, because the dynamics driving it.
Yeah, because you didn't have the sovereign nations standing in as challenging you for this quietly and through sovereign wealth funds and whatnot. It was speculation and leverage or two brothers. Ain't the case anymore. This is a whole different ball of wax, and that's why the people who rely on recency and normalcy bias will get blown away by this and won't notice it at all. And over the last month, Adam, I've talked to so many people, many of your people, who say something like this to me. Gosh darn it, for 3, 4, 5 months, I wanted to buy this stuff, and my advisor said I'm stupid to do so and don't do it. And what do you know? Here we are. And so the people giving advice, when you try and figure out where we're at, I mean, I'm using a lot of fact and a lot of intuition and supposition to figure out where the end game is, but fact-based, I think you have to separate yourself from where we once were and look at this as a whole new thing and realize we're in uncharted waters. That anyone's giving you advice is doing so based upon what used to be and what used to work. But my argument here is that those things are now becoming less and less and less relevant until they become irrelevant. And you have to use your gut. And I would say this to all of you out there. The key thing, if you are relying upon an advisor who doesn't look at the world the way that you do, is it the right advisor? Adam has all these advisors working in conjunction with what he's doing who understand the world maybe the way that you do. Wouldn't it be more appropriate to shift to an advisor, perhaps, even though he or she has done great for you up until now? Isn't it maybe better to interview an advisor who might look at the world through a similar lens? Because to me, that's what is going to dictate performance on your wealth moving forward, is the global macro view as things begin to change in a massive way. That to me is what people are struggling with. And, not to plug your service, which of course I am, but I mean it, because if you're going to get advice from someone, you might as well get advice from someone who has a similar outlook on the future and the way the world is, rather than someone who's been buried in a line of learning more and more about less and less till they're experts on nothing, thinking that the only way to retire is through a 60-40 allocation. I have an account at Morgan Stanley. Very good friend of mine runs $4 billion worth of money. One of the biggest advisors in the southern part of the United States in Morgan Stanley. And he wouldn't know a gold coin if it fell on his foot, yet their chief investment officer said sell half of your bonds, that the 60-40 model doesn't work anymore. So 40 of that 40% in bonds, sell half and put it in gold. So things are changing, and even the sophisticated people aren't aware of it yet, but you guys are. Think about that.
Well, first off, preach, brother. And yeah, I was sort of smiling as you were talking there, because I could just imagine the guys at New Harbor Financial sending you the biggest gift basket that they could think.
Yeah.
I feel exactly like you, and it's why I started Thoughtful Money and created the model the way that it is. And I will tell you, it's a challenge to find financial advisors who appreciate the role of precious metals. One, just from a like-minded macro sense, right? These guys are kind of, you usually find one of two people who are, just inundated in the way it's been done, and they're just using the old playbook. But also, a lot of these guys just look at precious metals and say, well, look, I don't make a commission, or I don't make any revenue off of owning that. So why do I want to recommend that to my clientele? A lot of the advisors that Thoughtful Money endorses, especially the guys at New Harbor, they oftentimes will say, look, we don't even want you to come on as a client until you have some foundational exposure to the precious metals. We think like that and paying down excess debt, those are things you need to do to get your house in order before we should be taking over the rest of your capital, right? But guys like that are hard to find.
Yeah, I think I need to open an account with them myself, because they are hard to find. And, I've had a really good relationship with Rick Rule for a very long time. I consider him a dear friend, and he's done more for me than almost anyone I've ever known in this industry. And when he was the CEO of Sprott, to this day, I do business with all their brokers. And by the way, as a financial advisor, you are able to do that if you disclose it. It is not selling away. And their brokers write business through me. And I will tell people when they call, who can I get as a financial advisor? Now I tell them to search you, because I would always say Sprott, but the pushback would be, but aren't they just, mining and natural resources?
Yeah.
And I said, yeah, they are. Well, a lot of people want something more well-rounded. So I say, look at Adam's program. And
thank you.
But it's true. It really is true that you need to, if you're going to work your butt off for your entire life, and then instead of taking the responsibility for doing it yourself, you're going to give it to someone to manage your money. At least give it to someone who has a similar view of the world right now the way you do, because, years ago it wouldn't have mattered. The West was the West, and everything was great, and it was prosperity till the end of days. You might have to reevaluate those, even the best laid plans now. And I think that's a good way to do it, is to call one of these advisors and interview them and see if just what they say about their world opinion is different from the way that you're getting it. A lot of the people I talk to, they're afraid and embarrassed, and they get beaten up by their advisors and their ideas, and they forget it's their money. And
yeah, exactly. Well, and especially around precious metals, I can't tell you, Andy, how many people, when I talk to them, say, I've just been asking my broker if we should be adding any gold to the portfolio, and he looks at me and says, "What are you, crazy?
Right.
Are you?"
And they belittle you. That's right.
Yeah.
And they should just admit we were wrong. Like, remember Happy Days, Fonzie? I was wrong.
Yeah, he couldn't
say I was wrong. Well, that's them. They can't say they're wrong, and yet they continue to stand upon that same hill and do the exact same thing. And I don't know. Sometimes things change. Nothing stays static forever, including empires. And we're pivoting. We're changing. Now, maybe the U.S. can still be the greatest country in the world, but it has to change. And that's what's happening. And to follow the same playbook may not be the best idea.
All right. Well, look, we'll move on to some other questions. We'll get off the commercial for Thoughtful Money's advisor services. But Andy, I do very much appreciate you bringing that up. And I know you're speaking from the heart. Folks, you hear me say this all the time, but if you want to talk to one of those advisors, obviously just fill out the very short form there at Thoughtful Money. All right. So I want to ask you about Rick in just a moment, because he very publicly, I haven't watched the podcasts, but I've seen the headlines. He very publicly appears to have sold a pretty sizable chunk of his silver position and some of his miners. I'd like to just get any thoughts you have on that. Before we do that, though, so we were talking about how, you know, the sovereign nations are now saying, okay, look, silver is a lot more strategic than we were treating it, and we're going to start making sure that we build up our strategic reserves of it as much as we can, both silver and gold, precious metals. Presumably, in this new world, I'm guessing you think what's good for the goose is good for the gander, meaning at the individual level, we should be building our own strategic reserves of it, right? And yes, it's a wealth building vehicle. There's still maybe a lot of room to run in terms of how far the true price discovery might go. But I also think, Andy, you probably think it's really wise to own it too, just from a, you know, we don't know what's going to happen with fiat currencies over time and things like that. And having your own physical hard assets that you control is going to be a big part of just sort of financial resilience going forward. So I'm going to ask you a question that's a little bit hard to answer specifically, but I just want to get your thoughts on it, which is, in your mind, for an individual, what's kind of like critical mass of where you're like, okay, you want to try to at least get X amount of ounces under your belt to become, you know, hit first stage of financial resilience. To give you an example, owning 2 ounces of silver isn't going to do it, right? So if you were advising kind of a regular person who was saying, look, I don't own this, or I only own a little bit, what kind of milestones would you encourage them to aspire to?
I guess it all depends upon what their wealth is. You know, for years, financial advisors would acquiesce to 5%, maybe 10. Well, like I said, you had the chief investment officer of Morgan Stanley say it should be 60, 20, 20. 60% stock, 20% bond, 20% gold. Michael Hartnett, the chief analyst for Bank of America, says no, it should be 25% stock, 25% bond, 25% short-term treasury, 25% gold. Jeffrey Gundlach, the bond king, says 25% metals is not overweight at all. I guess it's what it means to you in terms of a percentage. 2 ounces of silver for a 9-year-old might be an awful lot. It could be that's huge. But if you are someone who is working, you should be able to put a couple ounces of silver away every couple of weeks, like I've done for 36 years. It was the greatest gift I've ever been given in my life. My father told me he'd fire me if I didn't buy something every 2 weeks when we started this company 36 years ago.
Light a candle to your dad for that. That was fantastic.
But it's true, the power of compounding, the power of paying yourself first. So what is the magic number? I don't know that there is a magic number other than to say, you know, it should be a weighted percentage of your assets. And I honestly would tell you, look, I'll answer it this way. My company started as a representative of the Swiss insurance industry. That's where we started. We represented a company, still do to this day, called BFI Consulting in Zurich. We realized the same person that bought Swiss francs bought gold. But I spent my first 2 summers learning in Zurich. I spent 2 summers in Zurich learning the business, became very tight friends with a lot of people there, including Swiss bankers. I spent time at Marquis Baumann and got to know, this is a private old bank. I got to know the guys running it at UBS, Credit Suisse, at the insurance companies. And there wasn't a Swiss banker or head of insurance company that I ever met that wouldn't say to you, in the worst of times, or the best of times, you should have a minimum of 10% of your assets in gold and silver, minimum, in the best of times. Well, are these the best of times?
Right.
And if they're not, where does that number go? Well, you got chief investment officer of one of the biggest banks on the planet saying minimum of 20%, and the chief analyst of the other biggest bank saying 25%. I wonder what they really believe. To me, It's just a function of how much you have. And let's just simply say a minimum of 25% of your assets right now in a period of accelerating dollar debasement should be in metals. And if I really told you what I believed, you'd probably never have me on your show again because I'm the wrong person to ask. Look, I own one of the largest metals companies in America, and I'm pretty damn close to 100% invested in gold and silver. I have a managed account with Sprott. I have an account at Morgan Stanley, and I acquiesced to it out of my wife's demand. And I have some short-term treasuries through them. And I told them, don't even think about putting me in anything speculative. I have some infrastructure things that with, building up roads and bridges and stuff that is a bond that's backed by the U.S. government. I don't like any of it. So, but that's me. I'm the wrong person to ask. I just simply think we are at a period of time where things need to be reevaluated, that the old strategies might not work the way they used to. And the funny thing about it is that everyone would have called me an idiot for being this way for the last 20 years. And guess who came out ahead of everybody? Me.
Yeah.
Because, and I'm not saying I'm a genius or look, to me, it's almost like an innate understanding and it's spiritual to me. I've just known that I should do this. I can't explain it. I've just known, and I've always slept well at night, even though I missed out on a lot of stuff, all these booms in the Mag 7, I missed out on it. Fine. But, when my wife and I got together in 2002, gold was $252 and silver was $5 maybe. So, it's the tortoise, not the hare. My wife says that's the reason the price went up is because she got with me. But the point of it is that in a very short period of time, in under 25 years, silver has gone up from $4 or $5 to 90, right? And gold has gone up from 252 to almost 5,000. So who's been right? Who's been wrong? Have the financial advisors been right? Maybe this is why central banks own it, and maybe why they're rushing to get it. Maybe I was lucky. I don't know. All I can simply tell you is that you should have enough to make you sleep well at night, whatever that is for you. And I've always slept like a baby, even when everyone told me I was an idiot. Trust your gut. And, you're responsible for all the decisions you make your whole life, from the time you're a little kid until you're dead. Every decision you make, you're accountable for, right or wrong. Well, why do we allow people to dictate what we do with our finances when we spend our whole life accumulating them, working? And I think take some accountability and figure it out. But to me, 25% would be the baseline. And I honestly, if we were having a scotch right now, just you and I, those numbers would be much higher.
Okay. Well, I get it. And you're definitely a man who is passionate about his trade in this craft. And I'm thinking of, I think it was Andrew Carnegie, who, there's a saying, don't put all your eggs in one basket, diversify. And Carnegie was like, no. I put all my eggs in one basket and I watch that basket really carefully.
Well,
and
I would like to answer that real quick, if I may. I don't mean to interrupt you, but Richard Russell was my mentor. And in a conversation with him, he said to me something akin to diversification was invented out of fiduciary responsibility by financial advisories. The key to investing, he always said, the primary trend. Follow the primary trend, the way the river flows. Mm-hmm. The primary trend to me is of a debasing dollar. So if you want to be broadly diversified, you do not broadly diversified into stocks, bonds, real estate, and commodities, because they're all inversely correlated to a spike in interest rates, and they're all dollar-based. Instead, you look at the way the river flows, a debasing dollar. Okay, so you buy gold, silver, platinum, you buy mining shares, you buy agricultural ETFs or ag land, you buy oil and gas, you buy anything that you can buy that is opposite the dollar and broadly diversify within it. Now you're broadly diversified within the primary trend. And I would say that that is similar to what I do. There may come a time where the trend changes, and that's when you pivot and move from an overvalued asset to an undervalued asset. But right now, we're nowhere near overvalued because those values have never found price discovery. So you're right. I think Andrew Carnegie was right. Diversity is the best way to become average, the best of the worst of the worst of the best, because asset classes don't always move in harmony. But this is how you keep from getting sued if you're a financial advisory telling you what to do. Right. He told me to put all my money in it. No, That's not what we want to do. You want to be broadly diversified. Well, that's financial advisories. And this is what I mean about taking accountability for your own finances.
All right.
Or finding someone who looks at the world the way you do. Sorry.
No, like I said, you're preaching to the choir here. All right, I got a couple other questions I want to get through. I'm looking at the time. Do you got another 10 minutes in you?
I got no time restraints, so I'm good to go as long as you want to go.
Oh, you're a bold man to say that. All right, so first off, just because you mentioned oil and gas, the day we're talking, Andy, natural gas prices are up 22%. Now that's, I think, due to some of the cold weather that's about to hit the Northeast. But that's a whole other area that I think is sort of ripe for potential revaluation as well. The oil and gas industry, it's been suppressed or depressed for so long. But it's just interesting. There's a lot of people making a lot of money today. I'm sure there's some traders that are going to go out on stretchers too. But interesting time for natural resources of the sort that you listed. All right, Andy, I get this question a lot for you, and I'm sure you get it too. And I just want to give you a chance to answer it in the open. Now, the challenge you have of saying anything positive about where the precious metals are going is the criticism of, well, you're just talking your book.
Yep.
Right. You're a guy who sells this stuff, right? And you've explained enough on this channel, Andy, kind of your philosophy and all that. So I'm not going to ask you to rehash all of that. But the question I hear people say, it's a practical one, and I'm just curious to let you answer it any way you like, is, well, Andy, look, if you think the metals are in this great uptrend and they're going to go even higher and whatnot, then why sell? Why are you selling to the public? Why don't you just buy it and hold it and become, fabulously wealthy?
Can I be honest and simply say to you that to me, and I mean no disrespect, okay? But to me, that's, and I know you're just saying things that you.
I'm just the conduit for the question.
I find that to be about as naive as anything I've ever heard in my life. So a guy loves hamburgers and opens up a McDonald's franchise. Why the hell would you do that? Oh, it's like it's a business that when I started in this industry in 1989, nobody bought gold. Right? Maybe your grandfather and the World War II vets, they bought gold. Nobody did. Nobody did. And if we made $14,000 a month in profit, we were great. We were happy. So people look at it now and say that. It's been a business I've been in for 36 years this next month. I've been doing it longer than than anything I've ever done in my life. It's my child. It's who I am.
It's your legacy.
It's my legacy. And I believe in it so much so that for 36 years, I've never missed a 2-week period of buying it for myself. Now I have the good fortune of being able to run a business that sells it. And I think if people walked in my shoes for a minute and walk into a restaurant and people yell Andy Schectman from across the restaurant, or I go to the Sting concert at the Hard Rock and people are screaming, go silver from the blackjack table, or the pit boss comes up to me and says, I watch all your stuff, I would not put my face out here the way that I do, lying to the public. I mean, it's do I have a suicide mission, or do I want my children to grow up in a world where my name is mud? My point to you is that I believe in it in my soul, and I think you can run a business if you have the good fortune. Look, I don't have enough money to buy my inventory. We keep 100 million in inventory going at all times. This is how you build a business and do something you believe in. There's nothing more rewarding than waking up every morning happy to go do this. I've never woken up saying, damn it, man, I got to go to work again. Yeah, sometimes when I want to go play golf or something with my buddies, I live on a golf course. But when I wake up and know I'm coming on your show, I'm psyched. And when I wake up and say, I get to help people, and I go to bed at night, I look in the mirror and say, you know what? I get emails, honest to God, from all over the world, people telling me over the last few years I've changed their lives. I got one the other day that said, you just helped my mother achieve her life goals. And he says, thank you so much. I told her today she's a millionaire. And she's 84 and she's wanted this entire life. That literally make the hair stand up on my arms. And
those are the best. That's the best feedback.
Adam, you understand this. To be able to do something that helped people. Look, you were working, if I'm not mistaken, for Google, where that could have taken you to the stratosphere. Instead, you do this. Aren't you talking your book? No, you're not. You're helping people. Just because I own a precious metals company doesn't mean that I can't try and share with people the way that I look at the world and what it's done for me and what I see it as. So yes, I get it. There's cynicism, and rightfully so. There's a lot of people who aren't legit, who aren't authentic. But by now, all I try to be is authentic on these shows. I'm not as smart as Peter Schiff. He's way smarter than me. I just try to be honest and authentic and research and work hard and do the best I can to share what I believe is happening. And somehow I've been right for a long time. Somehow. And I ask myself, how the hell have I been right? I don't know. I try. Maybe if I have one talent in this industry, it's putting together dots, connecting them, and seeing where they're going. As people look at each individual piece all by themselves, I see a pattern that is coming and growing. And I've said it for 5 years now, and it's happened. Everyone told me I was an idiot when I talked about bricks in 2019 and 2020. What are you talking about? And then all of a sudden, everyone's talking about it. And I just think that the bottom line here is that there's nothing more fulfilling in running a business that you believe into your soul and participate in. The most egregious thing that you could ever do is run a business that you have no part in, right? And like, I just sell it. I don't own the stuff. Instead, I live it and breathe it and tell every one of my employees, if you want to work here, you'll buy every 2 weeks. And every one of them thanks me almost every time I talk to them. God, thank you so much, man. You know, since you told me to do that, and I've been here 3 years, 4 years, it's unbelievable what's happened to my life. Now, I just believe in it. And if you believe in what you do, you can be good at it. In athletics, I wasn't the best player on my team, yet I achieved much higher level than most of the people I went to high school with. And the thing of it is that you love something so much, you don't mind getting up and going to lift weights and getting up and going to be the first one at the baseball field and the last one to leave, and you're psyched about it, and you talk to everyone about it because you love it. Well, I love what I do, and I thank God every day that I do it. And that's the difference. That's why I sell it. And there will come a day where maybe I can't get it. I'm not selling mine. So I don't know. Good question. I get it all the time too. It drives me nuts because it's naive.
Great answer to it might have been a difficult question to field. I also say too, Andy, you're a very humble guy. You are very smart and you're very well informed, especially again in your trade here. It's interesting though. I just want to say this: when it comes to your Thoughtful Money is endorsed precious metals provider. I've got the advisors that I talked about there too. And what it's a very hand-selected process. And what I learned through the years, and it's really influenced who I chose, is you definitely want smart advisors. So absolutely. But it's like, the most successful people in life aren't the smartest. A certain level of intelligence you need, but beyond that, it's really grit that is a big determinant, right? Kind of how hard you work, how persistent you are. And I found that with financial partners, what you want is kind of the financial equivalent of that, which I call stewardship. It's just the getting up every day with, look, I want to do the best thing for the people who are putting their faith in me, right? So you want a smart person, but who's really motivated by that stewardship thing. And obviously, you've got that in spades. That's why I chose Miles Franklin. That's why I've got the advisors over here. So I want to call you out for that, but I also want to, say, hey, Andy, you're a pretty smart guy too. So don't smoke screen yourself too much there. You got a lot of brain power. All right. So I want to ask you. I'm going to ask you about Rick in just a second, his trades. But I want to get your opinion on the miners for a second, Andy. So I'm going to bring up two charts here real quickly. I'm going to bring up mining stocks. The reason why people invest in them is, if you're bullish on the metals, you buy the mining stocks because the mining stocks are a levered play on the metals themselves. You expect the mining stocks to do multiples better than the metal itself. And that is playing out with gold. I think people would say, hey, I kind of expected maybe a greater pop. But if you can see in this chart, and I know it's a little bit hard to see, the yellow line here is GDX, which is the main mining stock ETF. VanEck, by the way, since you mentioned them earlier. And then this green line is the gold price. And you'll see here over the past 12 months, gold's been up about 75%, and the mining stock complex is up about 170 something percent. So it is being a levered play. Again, maybe it could, folks maybe had higher aspirations, but it's still, it's more than 2x what the metal has done. But if you go to silver, if you look at the 1-year comparison between the main silver miner ETF, SIL, and the price of silver, they pretty much had the same return, about 200% over the past 12 months. So the question here is, wow, is the mining complex dramatically undervalued still here, right? I mean, should we be waiting for, should we be expecting here that the mining complex is going to reprice here to become the levered play on the underlying price of silver?
Sure feels that way to me.
What you think about that?
Yeah, sure feels that way to me. And maybe, I mean, there are fewer miners to choose from too. I mean, it's a consolidated.
Right.
There's only a handful of companies that mine silver.
Right. And there are a number of companies in the silver ETF that mine a whole bunch of other things. So it's not just pure silver. Yeah.
Yeah, I think that Keith Neumeyer's First Majestic is the purest silver play out there, and it's only about 60% of what they do. And that's because silver, your skin is epidermis, and silver is found epithermal, right at the top of so the big deposits were found forever ago. The majority of all the silver mining comes from byproduct of lead, copper, and zinc. And they stumble across it. So there's no incentive, price incentive, to start digging for silver when you're mining lead, copper, or zinc. You find it. And that's why, only about 18% of the metal, of the 850 million ounces mined, only about 18% of it, call it 160 or 70 million ounces, came from companies like Keith Neumeyer's. So I think that there is a tremendous upside still, and that chart would pay reference to it, to the silver miners. Absolutely. I think they are undervalued, and there's no reason to not have exposure to them. I think when you look at, to me, when I think of my mining position, I think of a pyramid, that the Swiss model that I've used forever. The base of my pyramid is 60 to 70% of my assets paid for real estate, gold and silver. And I want to say cash, but it's like a melting ice cube, but we'll say cash. Yeah. The middle portion would be 6-month treasuries or less, earning 3, 4, 5%, whatever, or a utility stock paying a dividend. Conservative, low growth, a little bit of return, a little riskier than the base of the pyramid. And the top 10% would be your mining shares if you're into cryptocurrencies, whatever it may be. The theory is you lose everything on the top 10, you make nothing on the middle 30, as long as your base is plodding along like the tortoise. You never go backwards. So in a perfect world, you kill it on the top 10, you do great in the middle, and the bottom doesn't matter. So I think that if you do not invert your pyramid, everyone should have exposure to some silver and gold mining stocks. I think the leverage is fantastic, and you can make more money on that top 10% than you can on the bottom 90. And I think, yeah, I definitely own it. I would own it. And I think silver, especially according to that chart, the miners are wickedly undervalued. And a little bit of cash in it can go a long way.
All right. Okay. So then now we get to the question about Rick. So Rick, super knowledgeable guy. You've already mentioned that, and you know him very well. I have not had a chance to talk to Rick, just FYI, folks. Rick's going to be on the channel next week. Primarily to do a deep dive in the oil and gas space, but I will ask him just for an update on this apparent trade that he's made in selling a good chunk of his. I think he said silver. I think it was silver and silver miners. I don't think it was gold, but we'll clarify that with him. He also said, "Hey, look, this is subject to change at any moment, right? Like I could easily buy right back in." I don't know if you've actually listened to the podcast and got more detail than I, Andy, but what's your general reaction to what Rick's doing here?
Well, First of all, if Rick and I, and again, I don't think there's anyone who is, he's one of the most intelligent people I've ever met in my life. I mean, freakishly intelligent, and articulate. He's almost like Shakespeare, the way he talks, man. And so
I love his way to turn a phrase. Yeah.
it's unbelievable. But I think if we differ in one perspective, it might be the way that we look at suppression of the markets. He might say they've been managed, but ultimately you can't control it. And I might differ a little bit respectively. Okay, with that being said, my take on it is he's been telling people to do this since silver was 15 bucks an ounce, 18 bucks an ounce. And at 18 and 20 bucks an ounce, which would have been 4 or 5 years ago, 18 bucks 4 or 5 years ago, now it's at 95. Well, that's a hell of a gain. He's a trader. I don't think he's selling his physical silver, but he may be moving from something that is appreciated fivefold into something like natural gas, which has been held back. And maybe he's the reason the price of natural gas went way up today, because he put all his money into natural gas. My point is, my guess is, if I had to guess, and I don't know, I will see him next week, as will you, in Vancouver. But my guess is that he... Are you going to the Vancouver Resource Conference?
I am. So
okay,
you're going to be there too?
Yeah. So I'll see you there.
Well,
Jay Martin's conference. Never miss it.
We'll get that, Brandy, and I'll find out what your true percent ownership of precious metals.
Beautiful. Yeah. So I think he's just taking advantage of being right for a long time. Took a while to get there. Taking some of those profits. Rick is the legend of moving and buying things that are undervalued when no one wants them. He'll tell you that's how you make money.
As Jack here said, Rick buys what's hated and cheap, and maybe that's all he's doing is buying.
That is what he's doing. It's exactly what he's doing, and he's the master at it. And he will tell you the biggest money he ever made is when everyone said he was crazy. He talks about one trade that he went all in or bought a lot of it. It lost half of its value, and he doubled his position, and then became extremely wealthy off of it.
Yeah.
But that's how he's. Not only does he have conviction, he has an immense amount of intellect and researches. Now, I don't think he would say to you that the silver run is over, but I think if you're a trader, taking those profits and redeploying them into something different. When you're talking mining shares and ETFs, it's different than holding stash in your house or in a vault. And I think that's what he's doing. He's redeploying it into something that is undervalued, taking a 500% plus gain that he's made and moving it. Now, I don't think he's selling all of it. And I don't think he's selling his physical, but I don't have most people haven't been in it as long as he has. Most people weren't buying shares at pennies like he was, because he bought it when no one wanted it.
Right.
So he's a little bit different. He's kind of a behemoth, right? And I don't think there's anything wrong with it. But I will say the one thing we differ in our perspectives is in perhaps the suppression and the story behind it. And I think that's what allows me to look at things a little bit differently. And I respect his viewpoint. And who's to say who's right or who's wrong? But I would say he's not completely out of it. He's just repositioning to an undervalued asset.
Okay. And folks, Andy and I will be up there in Vancouver with Rick this weekend. So we'll try to get whatever intelligence we can. And then, of course, let you ask questions to Rick when he's on next week. All right, Andy. Well, look, thank you for coming on again and just, again, being so transparent with all of your industry expertise. So you have been very kind over the past couple of months, and the timing couldn't have been better in terms of offering an exclusive offer to the Thoughtful Money audience. This was around silver. Initially, it was the ability to buy junk silver from you for $1 under spot. Given the aggressive CME margin hikes, that is now up to at least at last time $1.35.
No, we're doing it. We were able to secure a little bit more. It's at 99 cents right now. We just
my goodness. So it's now a better deal than last time you were on.
99 cents, and it's fluctuation. And real quick, the reason we've been able to do this, real quick, is that the companies like mine, who are smart enough to say, oh my God, this is just, it's never been like this. I'm buying every single ounce I can find. We have a network of coin shops all around the country. I put a feeler out to every one of them, hundreds of them. Anytime you get junk silver, I'll take it. All of it. Give it to me. I'll buy it all. Why? Why is this happening? The big companies get it. right? The other companies, small, mid-sized dealers, coin shops, they get this stuff in. And as I've told you, it's been for a long time, the public hasn't really been involved in this market. It's been the big traders and the very wealthy people who get it. So they get this junk silver, they pay for it, and it sits on their shelf for too long, and they want to get rid of it. So where do they normally go? They don't call a company like mine. Some do. I have relationships with lots of them. They don't know what to do with it. So they bring it and anything else that they'll take in terms of maybe China or flatware or whatever, and they'll bring it to the refiner. And the refiner takes that in along with maybe doré, or they take in jewelry or flatware or junk silver, all this stuff, and they pay the public for it. So you're a refiner with $30 million. You're not a massive refiner, but you got $30 million worth of silver in process, right? From when you take like silverware, that's sterling. The knife, the blade is stainless steel. The handle is plaster. It's just a little wrapping of around the handle of sterling. There's a lot of labor involved in breaking this stuff apart,
Right.
And so you have to refine it into shot. That could take time to get it into a refinable form. Then you refine it. That's little BBs. Then you take that and you melt it down into bars and rounds. This whole process may take weeks, and in various stages. So these refiners have to hedge their position, right? So I got two remote controls that are the same here. Here's my inventory in the refinery. Here's my short position on Comex, because if I have $30 million in working stages and the price drops by 10 bucks an ounce, I'm dead. I'm out of business. Right. But not so if I sold short. So it's market neutral, right?
Yep.
Well, what happens when A, margins raise, and B, silver goes up 3, 4, 5 bucks a day? You get margin called on your short position. These refiners like, oh my God, we're getting margin called every day. We can't do this. Stop taking new business. Stop. No more new business. That's why it's hard to find bars and rounds right now. And they're not taking any business. So all of a sudden, these dealers are like, what do we do with this stuff? No one's buying it. It's killing us. Well, the big houses, the big primary distributors say, well, we'll pay you $2 back a spot for it. I'm buying everything I can buy, all of it. And I'll sit on it if I have to. I can hedge the metal. There's no premium. We will see a period of time when that premium shoots to the moon again, like we saw during the pandemic. So for those of you wondering, how could we do it? It's because the refiners stopped taking business and the market just said, fine, we'll take it. And I will tell you that I've never seen a better value ever in my life, in my career in silver. We still have it at 99 cents over. I bought a whole bunch of $half. They're 99 cents over on $half. And we'll keep doing it as long as we can until we run out of it. But I think it's a zero risk bet when you're buying stuff that close to spot. What you're buying at the same price or less than a 1,000-ounce bar. I've never seen that before.
Wow. Amazing that that's what's happening in the industry right now. But again, just a lot of appreciation for you making that offer available to the Thoughtful Money audience to let them get in while there's such a low premium on it. Now, obviously, folks, we don't know what's going to happen with the price here. But, since Andy's been offering this, if you took advantage of it, a month or two ago, you've done very, very well given where silver's gone. So anyways, Andy, let me just let folks know if they haven't taken advantage of that offer yet, but thinking they might like to, they can just fill out the very short form here at thoughtfulmoney.com/buygold. And they'll be connected immediately with Andy and his team, and they'll be right in touch with you guys. And of course, they can do that for this specific offer. But if they also have other questions about precious metals, buying, selling, storing, et cetera, you can help them with that too, again, just by folks filling this short form out here.
Appreciate that so much, Adam. I've said it before. It's such an honor. You're such a well-respected person in this industry and a great guy. And I couldn't be more thrilled to have a friendship and an affiliation with your company. We take it really seriously, and I want to thank you and all your listeners out there. And feel free to take advantage of that. And I'm always available for questions. I'm spread pretty thin these days, but I've talked with a lot of your people, and we just appreciate the heck out of it. So
thank you. And as I've said before, the feedback that I get from folks that are dealing with you and your team, Andy, is pretty much universally positive. So thank you for taking such good care of folks.
Oh yeah.
Very selfishly, I am really looking forward to hopefully getting a little bit of social time with you up in Vancouver. So hopefully the next time.
Well, I'll make it happen. Believe me. I have one keynote speech and one panel, and the rest of the time, I'll be walking around looking for someone to fraternize with. So that would be great. I look forward to that as well.
All right. Well, my friend, I can't wait to see you there. Everybody who's watching, please do me a favor, a couple favors. One, please show your appreciation for Andy by doing a couple things. One, hitting that like button, obviously. And if you haven't subscribed to this channel yet, hit the subscribe button below, as well as that little bell icon right next to it. But if you can, especially if you're watching here in the live chat, just let Andy know real quick both your appreciation for him. And again, I've been hitting him a lot on these, but my sense is that even though I'm probably, the audience here probably still wants more Andy.
Mm-hmm.
And if that is true, let me know, because I want to keep delivering on more of the stuff that you guys want.
I should maybe have them send a quick note to my wife as well. Let her know I'm a good guy.
Yeah, I know. I was just at a conference and some people, came up and said some very nice things. And I was like, wow, could you write that down and send it to me?
Yeah, right. Exactly.
But
if they only knew the real you, my wife would say, if they only knew you're a child, she says, you're a child, you're a man-child. Yeah, but I think people who never grow up are actually the people that I want to hang out with. So who wants to grow old? Just stay young at heart.
Oh, very true. And by the way, I think last time we were hopping off, you were rushing off to do a family golf tourney. And
yes.
I remember you were looking to bring the hammer down into.
Oh, of course I did. Absolutely.
Okay,
I got to keep them in place. I mean, my daughter was the captain of her high school golf team. She's a hell of a player, but still can't beat me yet.
Well, you still got to prove who's the alpha, right? Even in the best of scenarios. All right, Andy. Well, look, my friend, again, can't thank you enough. Everybody else, again, thanks for giving your feedback to Andy. Looks like, of course, Andy, we're getting really good feedback here on you. No surprise
Appreciate
at all.
that very much.
Again, can't wait to see you up in Vancouver. But again, just thank you so much for everything you do for the general public in terms of education, but also helping them take steps to improve their financial status, and the fact that you are giving so much of your time and your inventory, your special inventory to this audience. It's just a wonderful friendship and partnership. So thank you.
Likewise, brother. The pleasure is mine. Thank you, everybody. I appreciate it. Look forward to picking up where we left off, and I'll see you next week or later this week, even this weekend. And have a good one, Adam. Thanks for having me back on today.
All right. Thanks so much, Andy, and everybody else. As always, thanks so much for watching.
The purchasing power of the dollar has fallen 99%. Those are the numbers you're saying. 99%. The dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce. And that was from, 1856 or something. And it was... it was de facto, but then it became de jure with the Gold Act in 1900. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. That's so much like Germany between 1922 and 1923.
Although the dollar's decline began earlier, it has already lost about 99% of its purchasing power since it was separated from gold. Deutsche Bank has explicitly warned of a crisis of confidence in the US dollar, suggesting that shifts in global capital flows might overwhelm usual currency fundamentals, causing erratic moves. JP Morgan says the dollar's long bull run is ending, with an expected 10 to 20% medium-term decline against the euro and yen. They see this not as a collapse but as a gradual reset. By 2026, increased tariffs and a failing dollar might cause prices to rise, a scenario similar to Germany's inflation crisis in 1922 to 1923. The dollar has lost around 99% of its value, albeit the slide started earlier. The 1900 Gold Act established that $20.67 would purchase 1 ounce of gold until 1934. Now, in mid-2025, JP Morgan warns that U.S. tariffs, trade policy, and slowing growth could lead to stagflation. They lowered their U.S. GDP growth forecast for 2025 to 1.3%, from 2%, owing to tariff impacts. They also expect foreign demand for treasuries to decline, which weakens one pillar of dollar strength. The International Monetary Fund (IMF) has also flagged that recent U.S. tariffs could add inflationary pressures and warned of weakening domestic demand and slowing job growth. The Roaring Twenties and the 1929 crisis were both exacerbated by Hoover's tariffs and the Fed's credit expansion under Benjamin Strong. Now, the risk is much higher and might destroy the currency due to Trump's tariffs at the height of a huge debt bubble. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. I mean, this is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
I mean, Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed it up. We need a strong leader. And what do they get? They got Hitler.
Germany experienced three stages following World War I. The first, from 1918 to 1920, saw the mark lose roughly 80% of its value, akin to the inflation that followed the COVID-19 pandemic. The second, from 1920 to 1921, saw a brief improvement as the mark strengthened, business resumed, and optimism returned. And the third, from late 1921 to 1923, concerning parallels can be seen in the US today. Officials are publicly pushing the dollar lower, markets have soared, and bond yields are still high. Only short-term T-bills are in demand, as foreign investors are shunning long-term treasuries. The dollar may plummet if bond yields increase while the Fed lowers interest rates. When tariffs are added, we may witness a crumbling dollar and skyrocketing prices by 2026, akin to Germany's hyperinflation. Since exporters benefited, politicians and business groups at the time even favored a weak mark. Similar to this, current policies run the risk of devaluing the dollar's purchasing power even while they may benefit certain groups. Let's dive into the interview.
Yeah, we're not quite there yet. I mean, you mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were three phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, and a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. I mean, things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
1921.
Sorry, between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, da-di-da-di-da. And now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. They are going to destroy the dollar.
Yeah.
The foreigners so far and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Now, on top of that, what do the foreigners do? Well, everybody, including the large institutions, stand back and they don't buy treasury bonds. Certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect, but it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And I mean, that's so much like Germany between 1922 and 1923. So the next question is, I mean, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. How? Because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. I mean, it was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it.
The warning signs are obvious, and preparation is crucial, regardless of whether the dollar experiences a similar fate. Will authorities intervene before it's too late? Or do you believe the United States is on the verge of a disaster akin to Germany's collapse in the 1920s? Should the dollar really start to depreciate by 2026, how should investors position themselves? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you.
Based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to $4,500 or something huge. It could really have a big move at this point.
Analysts project a rally into the $3,700 to $4,100 range, representing a move of over 20% from current levels, similar to the breakouts seen in 2007. Goldman Sachs maintains a base target of $3,700 by year-end and $4,000 by mid-2026, while noting that in extreme scenarios, prices could rise to as high as $4,500 by year-end 2025. Momentum is strong, sentiment is bullish, and key catalysts, such as rate shifts, geopolitics, and safe haven demand, are aligning for a potential breakout ahead. Chris, founder and CIO of TheTechnicalTraders.com, recalls that back in 2007, gold was expected to rise by about 20%, but instead it rallied 37% as equities peaked and began to decline. Today, analysts observe a similar setup, with gold forming a classic bull flag pattern and Fibonacci targets projecting gains between $3,722 and $4,100. If momentum builds and the trade becomes crowded, some forecasts suggest gold could even overshoot toward $4,500. Should equities weaken, history indicates gold could surge even more strongly, with silver and mining stocks likely to follow. Traders are watching closely for technical confirmation, particularly a breakout to new highs in ETFs like GLD. Meanwhile, physical gold buyers are steadily accumulating, seeing it as insurance before a significant breakout. Once gold truly takes off, physical supply could become scarce as investors with access keep it locked away. That's why many prefer to stack and store gold now before a potential perfect storm drives demand through the roof and makes it nearly impossible to acquire at any reasonable price. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
This type of scenario, gold actually had an upside move, a measured move in 2007, just as the stock market was putting in a significant top, which I think is close to where we're at right now. Gold should have rallied 20%. Not only did it rally 20%, but it blew past it and went up 37%. And so right now we have a very similar chart pattern. Gold, if we flip back to the chart of gold, has this, I love to use Fibonacci extension, Fibonacci theory. If you don't know it, you have to look into it because it's in everything in the universe. But more or less, it tells us where the upside targets are. Now, based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point. So
Yeah.
I like gold. It has this giant bull flag pattern. I'm waiting for an extra, like a discretionary trade, just a side trade that if gold starts to break out to the upside, I want to get long and play this move because I think it'll be a very quick move. I think it'll be very strong to the upside. And if you compare what happened in 2007, if we were to just scroll forward,
Right.
we saw the stock market fall 20% and we saw gold shoot up 37%. And I believe we could see something similar. If we were to fast forward this, we would see, the stock market potentially top out and start to sell off, and gold just keeps going higher and takes off. So that's an opportunity. This is a very rare type of setup that's unfolding. And I think one of the key things for, short-term traders is if we look at the price of gold futures here, and I think this is very important for people to understand, is gold did break to some new all-time highs on the futures market, but that's not what I follow when it comes to trading gold for a trade. I like to look at any gold, physical gold ETF, GLD or whatever. If we zoom in on the chart price action, you can see we never did hit new all-time highs back when futures did. So I'm really looking for gold to break above, when GLD closes above 1750 more or less, I'll be like, okay, you know what? This is it. This bull flag is breaking out, and probably we got chaos in the stock market. This will be kind of the play for gold. So gold has got huge upside potential, and I think it'll bleed over to silver and miners as well. I think the people who take physical gold are extremely savvy. They have a ton of cash because they're buying it. I think it's very smart to be loading up on physical gold because there's gonna, I think, eventually be a time, Daniela, when gold is shooting through the roof. Nobody can get their hands on physical gold. It'll be like impossible to get because anybody who has access to it is just buying it up. It's not even getting out to the public. I think getting your hands on it before, obviously, it rallies and potentially we're in a perfect storm for gold and silver to explode to the upside. I think getting your hands on it is important. That's what I do. I collect physical gold. I just store it. I keep stacking it. I think I don't really do gold for a trade. This
Right.
gold trade I just mentioned to you is like, I'll jump into an ETF. I'll play that move as a trade, but I do accumulate physical gold. I keep it stored away and I want to have it in hand. So people accumulating the physical, taking massive delivery, I think they're just really savvy investors saying, hey, if this does take off, they want to make sure they have it because a lot of people will want to buy it. And there's a lot of ways to buy gold and you actually don't really own it. There's a lot of different ways that it's done, that you might not actually be able to get it if you really did want it. And the whole world is all fighting for it.
Silver continues to shine, but with volatility, as the iShares Silver Trust ETF is up about 33% year-to-date in 2025, drawing attention from options traders who are capitalizing on elevated implied volatility. Silver remains more volatile than gold due to its smaller market size and dual roles as both an industrial metal and a precious metal. In the near term, analysts and institutions forecast silver to reach the $40 to $50 range, with a potential for $46 to $47 by mid-2026, supported by technical strength and growing industrial demand, particularly in the renewable energy and technology sectors. Meanwhile, the gold-to-silver ratio remains unusually high, suggesting that silver is still undervalued relative to gold. If this ratio reverts toward historical norms, silver could benefit substantially from mean reversion. Gold, on the other hand, is viewed as the global barometer of risk, signaling when something in the financial system is breaking down. Its current pattern suggests a major breakout ahead, with investors moving away from stocks and real estate toward gold. This shift is seen as a warning sign that uncertainty is rising and markets may be approaching a turning point. In essence, gold is flashing caution, while silver offers explosive but unpredictable opportunities. Let's redirect our attention towards the interview now.
So silver is wild. It has a very ugly chart. It has a lot of noise, huge pops and drops, big rallies, big sell-offs. It's definitely more volatile. And I think that has to do with silver is a lot more of a speculative play. It's a smaller market, so it moves faster. Gold I like because it's kind of the global barometer. It's the whole world gets nervous. When gold moves up, it means globally there's weakness and people around the world are seeing something bad happening on the horizon. And that's what the big chart of gold is pointing to, is we're on the tip of something hitting the news, something that's going to change everything. I think that's what gold is warning us. But silver does have upside potential. I mean, it's in an uptrend. I think it could rally to short-term wise, the next upside target short-term is about $40.75, not that high from where it is. But as you know, silver, when it does take off, it kind of just shoots and goes ballistic. If we were to zoom way out on the chart, it can have these massive, explosive moves. And it's really tough to gauge. Silver moves very quickly. If you blink, you can miss it. You kind of have to be sometimes just positioned in it and stomach the volatility. And then if that hits, then you're a part of it. But a lot of times some of these moves happen in 1 or 2 days, some of these big pops and drops. But when we look back on this chart, there is potential, though. We see gold shoot higher and silver could go up and tag that, all-time high of $50. It could spike up to that level. It would probably do similar to what we saw back in 2007. We saw silver. Let's just zoom in on that price action. In 2007, we saw, just as the stock market really started to sell off, we saw silver shoot higher. Percentage-wise, on average, it moved up about 20% or so. And interestingly enough, the chart pattern for gold and silver right now, Daniela, is gold actually has more upside potential. It's the opposite of what you think. It's the opposite of what everyone else thinks. They naturally go to silver for the bigger gains. But for some reason, all of my chart patterns for silver, and even when you compare what happened kind of back over here, it has the same or less potential for some reason based on technical analysis than gold. So I like gold because it's stable and I think it's going to be a big move. But we'll just have to see how this unfolds. Obviously, silver, if we were to go back, silver did have a pretty massive run from these lows. It was roughly the same, about 40% or more from like what gold did. Gold did about 37 as it broke and shot higher. Silver also did about 37, somewhat from the same time frame. So you kind of pick your poison, spread your money between both if you wanted to, right? Exactly. I think gold to me is the ultimate tool of uncertainty, and it looks like it's about to pop and blow up to the upside. And I think we're on the cusp. I mean, a lot of people, I've been expecting a big market correction to come at any point. I'm not jumping in front of it and betting on a huge correction in the economy and the stock market. If it wants to keep going up, I'll follow the trends higher. But gold is just screaming. It's like something is about to break. Something is wrong. People are moving away from real estate. They're moving away from the stock market. They're going into gold. And it's just telling us, just be cautious, right? It's kind of that warning sign.
Gold is indicating systemic stress, while silver is presenting high volatility upside, and both metals are setting up for potentially significant rises. The undervaluation of silver and its industrial demand could result in disproportionate gains, even if gold is the better long-term insurance against financial turmoil. When taken as a whole, they show that investors are becoming increasingly concerned about the state of the economy and the potential move away from traditional assets. Could gold's rise surpass current forecasts if there is a significant decline in stocks? Will silver ultimately beat gold in the upcoming bull market era if the gold to silver ratio returns to normal? Post your ideas in the space provided for comments below. Please support and enable notifications if this video is helpful so that you can stay up to date with our latest videos. I'll see you in the upcoming video. Thank you for viewing.
I think we've got another 5 to 10 years in gold.
Best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Gold and silver remain in a long-term bull market, driven by central bank buying, ETF accumulation, and rising debt that prompts investors to seek inflation hedges. While gold still has another 5 to 10 years left in its bull market. Analysts like Mario Innaco and Clive Thompson believe prices will continue to climb until a major crisis, whether driven by monetary, geopolitical, or systemic forces, forces a reset into a new currency system. Until then, market sentiment suggests continued gains and a potential final explosive rally within the next decade. The speaker, Mario Innaco, a financial market expert, mentions that Bert Doman, founder of Doman Capital, conducted a long-term cycle study of gold reaching back centuries. He identified a 20-year bear market that started in 1980, which ended around 2000, followed by a secular 30-year bull market that began in 2001. Based on this, he believes the current gold bull could continue through 2030 to 2031. The narrative of a prolonged upward trend amid systemic financial pressures finds strong consensus among many observers. Based on this, it is concluded that gold still has another 5 to 10 years remaining in its bull market. Clive Thompson notes that the bull market in precious metals is likely to continue until a new dollar, pound, or gold-backed currency, or a central bank digital currency, replaces the current currency system. Until then, rising government debt and recurring monetary, bond, or geopolitical crises will continue to drive investors toward inflation hedges. The excerpts from the interview are now available. Please click the bell symbol to receive timely updates, and subscribe to our channel before we continue our conversation. Thank you, and have fun watching the video.
I think we've got another 5 to 10 years in gold. So yeah, in the commodities bull market. Why do I say that? Well, I listened to Bert Doman. He's a fund manager, and I think he started out in the 70s. He's originally from Germany, but he's US based. And he said that in the 70s, he got his clients into gold in the mid-late 70s, and they did very well. And then in 1980, he told them, you need to get out of gold. We're going to have a 20-year bear market. And everyone thought he was crazy, but he was right. And then he said, but after that, there will be a 32-year bull market. And I think he looked at the price of gold going back a few hundred years in the UK, because the UK and the US are linked, the prices. So if you add 32 to 2000, you get 2032, and that's why I'm looking for another 5 years at least. But I think Jim Sinclair used to say that the next move higher in gold, let's say, it's not going to be like in 1980 because we went up to like almost 900, and then the next 20 years we drifted between 250 and 400. He thinks it's going to stay up there next time. It's going to be different. So I'll let Clive answer that.
Well, I think the bull market, if you like, if we could call it bull market in precious metals, continues until such time as the currency has to be replaced by sound money. So how long does it continue? I think at best, the currency we have up today is going to last another decade. And I mean, at best, I really don't think it's going to last that long at all. So whilst we're still in the currency system we're in, I believe we're going to see the gold price, the silver price pushing higher and higher and higher. And then at some point, there's going to be a crisis, a monetary crisis, an interest rate crisis, a bond crisis, a currency crisis. We don't know what it will be, or it'll be some external crisis, whether it be war or civil war or some event that we're not expecting, some black swan event. But these things come along and they'll be pushed into a situation where people are running to the shops to get anything which will preserve its value. And at that point, we'll start with a new currency of some description or restrictions of what you can do with your old currency. And at that point, we go back into a new system with a new dollar or a new pound or a gold-backed currency. We don't know exactly how it's going to look. It might be the central bank digital currency where you've got restrictions on how much of your old currency you can put into the CBDC. Whatever it is, until we get to that new system, the gold price and the silver price, I think, has to go higher because there's literally more government debt coming into the planet, and that means someone else is getting that money, and they have to invest that money somewhere. And the more this government debt expands, the more they're going to choose an inflation hedge like gold.
Rafi, in the interview with Clive and Mario, recalls that the gold to CRB ratio indicates gold's value relative to other commodities. Since 2000, it has been in a clear bull trend, despite occasional pullbacks. The 2020 oil crash, when prices briefly went negative, sent the ratio into an extreme spike. However, since gold and silver bottomed in 2022, the ratio has been climbing again. Currently, the chart suggests we're halfway through this significant upswing. Unlike during the lockdowns, oil and other commodities are not depressed. Yet, gold is still rising strongly, indicating solid momentum in its ongoing bull market. However, Mario, along with Clive Thompson, notes that with the global adoption of Basel III capital rules now underway in the US, allocated physical gold is formally recognized as a Tier 1 asset, on par with cash and treasuries. This institutional shift underpins the demand for gold, reinforcing its status as a financial backstop amid potential changes to the monetary regime. Governments are rapidly developing central bank digital currencies. The EU is fast-tracking its digital euro proposal to counter the growing dominance of US-linked stablecoins, while China is expanding international use of its e-Chinese yuan and considering yuan-backed stablecoins for cross-border trade. The UK is also developing a digital pound, with consumer usage expected in the late 2020s. Now, let's have an insight into the interview.
So this is the gold to CRB ratio. All right, so it goes back all the way to 2000, but I picked 2010 here just so you could see.
Yeah.
This is if we're in a gold bull market, then this is the value of gold in terms of other commodities. The higher it is, the higher the gold value is relative to other commodities. So, and we've been in a bull market since 2000, but there've been major pullbacks. Right, this is 2022 when gold and silver bottomed. I think silver bottomed at like $16 or something like that, maybe a little bit more. And we've been climbing ever since then. This was the oil, the lockdowns when oil went to negative 35, so that's why it went so high here. But like we're about halfway up this spike when the lockdowns happened, when oil went to negative. So if we're about halfway up this major spike, which was an all-time high, and other oil is not anywhere near negative now because the economy isn't shut down. So gold is it's going pretty fast now.
Well, we do take long-term mortgages, but the rates are set short-term, like 2 and 5 years. So they are based on the like 2-year swap rate, they call it, and the 5-year. But I think long-term rates, what they've been going up a lot. They're making like highs, 27-year highs, like the 10-year, well, the 30-year yield. And what that will do is that's going to hurt the government. That's going to increase the deficit. That's going to inflate things even more. And I think the Bank of England is going to have a tough time cutting the short-term rate. So even though in the UK we don't use the 10 and 30-year rates to set mortgages, I think things are going to remain tough. Clive?
Well, banks, when they lend money for a mortgage, whether it's in the UK or any other country, they are effectively lending that money out for the next 20 or 30 years because they're not realistically expecting anyone to repay the mortgage in the next 6 months. So, of course, long-term rates have to have an effect on the interest rate they're going to charge you on the mortgage. Yes, there's an influence in the UK because they set the rate in some way to the 2 or 6 or 5 year term, and then it gets rolled over at a higher rate regularly. But at the end of the day, if long rates are pushing higher, the banks have got to have their heads screwed on and say, well, we've got to charge our customers a little bit more, because at the end of the day, the alternative, we don't have to lend the customers the money on their mortgage. We could go and put the money into a 30-year bond, which is effectively the same thing, instead of lending it to my customer. So if the 30-year bond rates were to go to, say, 7%, you won't be able to, I don't think you'll be able to get a mortgage for less than 7, for sure.
Rafi, you got an opinion on that?
Yeah, so what Clive is saying makes logical sense. If a bank can lend the money to the government with much less risk than it can lend to somebody for a mortgage, with a much lower default risk to the government, obviously, then whether 30-year mortgage rates officially set mortgages or unofficially doesn't make that much of a difference. It makes a little bit of a difference, maybe in short-term fluctuations and stuff, but there shouldn't be too much of a spread between 30. I mean, there shouldn't be more 30-year mortgage rates shouldn't be substantially lower than 30-year bond rates. It shouldn't be lower at all, but if it is lower, it shouldn't be that. It definitely shouldn't be that much lower. So yeah, their mortgages are set by long-term rates, either formally or informally.
Gold and silver remain firmly in a long-term bull market supported by systemic pressures, central bank accumulation, and the institutional recognition of gold as a Tier 1 asset. With CBDCs on the horizon and financial uncertainty growing, precious metals are positioned not only as hedges but as anchors in a shifting monetary system. Meanwhile, miners' renewed strength suggests the bull market is still in its early phase, with significant upside potential if gold prices hold above current levels. Do you think the rise of CBDCs will accelerate demand for physical gold as a parallel store of value? Could gold miners finally see a sustained re-rating, or will they continue to be a niche play despite strong fundamentals? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.